I'm Rob Stambaugh, president of the AFA this year. Welcome to this celebratory luncheon. This has been a very special year for the finance profession with the awarding of the Nobel Prizes. And to get things started, please stand and join me in welcoming Nobel Prize winners in economics 2013, Lars Hansen and Bob Shiller. Of course, there was a third recipient of the prize, Eugene Fama, who unfortunately very much wanted to be here, was planning to be here, but he fell ill. It seems there was some pneumonia going around. Lars came down with it a bit earlier, and he's still recovering. But Gene, unfortunately, was unable to make it, and we certainly send him our best wishes. What we have planned for the event here, after you finishing up your main course, is to have a panel discussion led by our program chair this year, Luigi Zingales. And we're very grateful that at last minute Ken French has agreed to fill in for his longtime friend and colleague, Gene. We look forward to that. And with that, I'll let you enjoy your lunch, and Luigi will convene things a bit later.
So first of all, thanks for participating to this panel, which means a lot to all the AFA members and the finance community at large. So I would like to start with a very obvious question that everybody wanted to ask. In a sense, nobody questioned the quality of the contribution that is outstanding. People have sort of wondered a bit the combination of the name chosen altogether. So I want to, in your awards, sort of not only why you won a prize, but why you won a prize with those two other guys. Why don't we go in this order?
This order? Okay.
Yeah.
Well, first of all, I should say I'm not willing to defend why I got the prize since I wasn't on the selection committee. But nevertheless, let me not discard my time. I think I will say something about the award, and it might be interesting. So, first of all, my own perspective on my contributions. My initial background was in econometrics and macroeconomics, and some of my important contributions have been to time series econometrics. My entrance into empirical asset pricing was really from an outsider's perspective that I think proved to be advantageous, and I was lucky enough to have important collaborators stemming from my time at Carnegie, Bob Hodrick, Scott Richard, Ravi Jagannathan, and especially Ken Singleton. And they just helped me explore asset pricing from the lens of from econometric methods that I was simultaneously thinking about. So I was, and I continue to believe in the important role for formal statistics, a role that pushes us beyond impressionistic approaches to financial time series. Now to the perhaps more interesting question, why did we get it together? So while in Stockholm, I had informal discussions with members of the selection committee on this question. One of them gave a somewhat flippant comment, and he drew comparisons to the Myrdal-Hayek Award. Now my problem with that is I saw no Hansen counterpart in that award. Perhaps it's a counterpart to Myrdal, perhaps it's a counterpart to Hayek, but there's only two people in that one. Now, I certainly had some more thoughtful conversations on this topic, and so let me elaborate, let me kind of conjecture why I think it's perhaps an interesting bundling. I believe all of us were engaged in assessing empirical puzzles in asset pricing. Puzzles are only well-defined in terms of models. And of course, models by their very nature are wrong. But the question is if they are wrong in important ways or unimportant ways. And I think we all kind of took an empirical outlook on this question with the aim to build better models. What I personally find is interesting empirical challenges are, going forward, are risk prices as encoded in stochastic discount factors show substantial fluctuations. They appear to be larger in magnitude in bad macroeconomic times than good ones. I think we really don't yet understand why. Are these risk prices more generally uncertainty prices? To what extent can we distinguish the role of risk from investor beliefs? So I think there remains interesting empirical challenges going forward, and I really hope that the younger researchers out there can show us big advances on these dimensions. Thank you.
Thank you. Bob, it's your turn.
Well, I noticed that the Nobel Award in economics that was created in 1968 said it was for economic sciences. And there were some people wondering why do they say sciences, not just economic? I think it has to do with the fact that there's a lot of loose work done in economics, a lot of strange work, and they didn't want to be involved in awarding that sort of thing. So they said economic sciences. And it's interesting, I was looking back at the history of this. In the 19th century, they used to refer to chemical sciences. And why was that? That was to distinguish them from alchemists and other nuts that were doing chemistry. And apparently they thought they still had to do that for economics. So that's what I see in the three of us, that there's a common scientific thread. There's a different way of describing our outcomes. And I see the biggest, I don't know how to classify Lars. I think of him as my friend, but I think Gene thinks the same. So that's just the way it goes.
I'm enemies of both.
The differences seem to be in substantially rhetoric. That Gene has a fixation on this word bubble. It didn't. Maybe this divides the profession too. I mean, different people have different reactions to bubble, and he referred to it during his Nobel talk as that nefarious term, the bubble. Now he likes efficient markets because, of course, he basically coined the term, invented the term. So you understand that. But why is he so hostile to bubble? And I was thinking about this as the week progressed. And I realized that he and I don't have the same meaning for the term. So for me, bubble just refers to noise, like Fisher Black in his AFA presidential address said, it's a very quotable, I don't know if you all remember this, he said, I believe markets, I'm quoting him roughly, I believe markets are efficient. Efficiency means to me that 90% of the time, prices are within a multiple of 2 of fundamental value or a multiple of a half of fundamental value. And I thought, well, that's sort of, I like that definition of market efficiency. Similarly, the question of what is a bubble. And I realized, it seemed to me at the end of the week, we had lots of discussions over Nobel Week, that Gene thinks that a bubble means something that builds steadily as you're blowing a bubble, right? And it gets too big and bam, it's gone forever. And that's just not the way financial markets work. It's not like that. And so I guess maybe he's right. If that's the definition of a bubble, I don't believe in bubbles either. But the basic thing that is that I think there's a core to all of our research, and in terms of a scientific study, of a statistical study of financial market. And I read Lars and Gene. I trust them. I feel that we are actually very similar if you pull away from that. I think the biggest difference is that I'm more interested in psychology than Gene is, and maybe more than... So I've worked with Dick Thaler on a series of workshops since 1991 on behavioral finance. But that's not a fundamental difference because I still believe in the other kind of work. It's just a matter of interests.
Thank you. Ken.
First, Gene wanted to apologize for the fact that he could not be here today. And I guess I want to apologize for the fact that I am here today. And then when Luigi told Gene that I was going to be representing him, he immediately contacted me and said, "You are going to read a speech that I gave." So rather than react to Luigi's question, let me give you some background to what I'm going to read. It's actually pretty interesting. At the end, after the big ceremony in which the king gives these nice young men their medal and shakes Lars' hand and gets sick afterwards. And,
Did the king get sick?
I don't know, he didn't tell me. I haven't talked to him this week. Oh, you didn't mean Gene? No. They have a big dinner where 1,400 people are served dinner in this, it's the courtyard of the town hall as I understand it. And at the end of it, the oldest laureate from each of the fields gives a toast. And so this is the toast that Gene gave at the end of that big, huge banquet at the end of the big day. So it starts with, and I got to read this because it's sort of incredible that Gene said it, Your Majesties, Your Royal Highnesses, Your Excellencies, honored laureates, ladies and gentlemen. Let me begin by thanking the committee for granting this year's prize in economic sciences to me, my colleague Lars Peter Hansen, and Robert Shiller. I have learned much over the years from Lars' work and from listening to his penetrating comments on the work of others in the University of Chicago's many research workshops. I have also learned a great deal from Bob's writings and from his presentations at Chicago over the years. Bob and I agree on many things. We disagree on others, but always cordially and with an eye toward learning more from someone with a different viewpoint. Important to me personally is the recognition the prize gives to the standing of finance in economics. When I started in the early 1960s, finance as a serious research area was just getting started. We had Harry Markowitz's magnificent Chicago PhD thesis on portfolio theory, and we had the theorems of Merton Miller and Franco Modigliani on the irrelevance of the financing decision of firms. Spurred by the coming of computers, empirical research on what has become the theory of efficient markets was getting underway. That was it in terms of the major paradigms. There were no good research journals in finance, and almost all the serious action in finance was at two places, Chicago and MIT. Research in finance exploded over the next 20 years. William Sharp, John Lintner, Robert Merton, Robert Lucas, Douglas Breeden, and others developed our major asset pricing models, prescriptions about how risk should be measured, and the relation between risk and expected return. Fisher Black, Myron Scholes, and Robert Merton developed the first rigorous options pricing model. Equally important, an army of excellent young empirical researchers, Lars and Bob are among the best, entered finance, and all the major theoretical paradigms were put through the empirical ringer many times. Today, research in finance continues its impressive growth. Most major universities have first-rate research faculties in finance. There are now at least 5 excellent research journals in finance, and there are others that are better than anything we had in the 60s. The major paradigms of finance are familiar to PhD students in other areas of economics, and due to the work of people like Lars and Bob, finance now has a major role in macroeconomics. In my view, after 50-plus years of vertiginous growth, finance is now comfortably first among the areas in economics in which there is a rich interplay between theory, empirical tests, and the development of models to accommodate the challenges raised by the evidence. In the applied domain, finance is far and away the most successful area of economics in terms of penetration of theory and evidence into real-world applications. The expansion of the finance industry over the last 50 years parallels the development of academic research in finance and has borrowed heavily from it. Research in finance has been and continues to be a great ride. It has been incredibly satisfying to participate in the growth of finance and to know and learn from all the old giants who created the field and the new giants like Lars and Bob who continue to push its boundaries.
So
So thank you very much for reading this. This is quite moving for the entire profession. But I would like to pick up on what Bob left, because he actually surprised me by saying that if you define bubbles as sort of what we thought as kids as bubbles, something that grows and then explodes, you don't believe that there are bubbles.
Well, sometimes it's suddenly, sometimes there's a sudden change. That's not okay. The idea of a bubble has been that it's a psychological phenomenon, that people are buying into an increasing price asset because they expect naively that prices will increase further. And there's a word of mouth effect, and excitement grows. Now that can't go on forever. And so it sounds like a plausible end story, that once people see that it's over, and they want to get out. But I don't think that's such an inevitable end to a bubble. Why is it sudden? It might, come. And historically, the classic example is 1929. If you plot stock prices through the 20s, they were growing exponentially, it looks, on the plot, and then there's this traumatic collapse. But even that story is, then in 1933, they started going up again, and it was almost as big. And so it's not a one-time thing. Peter Garber, in his book Famous First Bubbles, makes the same point about the tulip mania. It's just volatility. It's not a one-time only event. So I think that there's a problem with using metaphors in science. Bubble is a metaphor, and it's attractive for popular discourse. And I end up using the word because everybody else uses it. But it's wrong to think that the metaphor is a theory. It's not a theory. It's a name for a phenomenon. And I don't think that sudden bursts is the important characteristic of what I call bubbles.
So what you call bubble is a sustained deviation from fundamentals driven by psychological factors, more or less.
Yeah, well, I think of it as a contribution to economics from other disciplines, notably epidemiology in the medical school, population biology. They talk about rabbits. There will be epidemics of rabbits, and then there'll be a sudden crash when there's too many rabbits. It's the same kind of phenomenon that we see elsewhere, and so that's why it's a contagion effect, just like your viral pneumonia. That was a sort of bubble. So to me, there's kind of a unity of science, and that we learn from other sciences, and these movements in stock prices have interesting causes. Sometimes it fits in with a theory very well in terms of fundamentals and risk, and sometimes it doesn't. So I think you were going to ask about efficient markets, so I'll let you come to that.
Okay, they stole my microphone. Okay, back my microphone. So what I would like to sort of help the profession understand, and myself as well, is if you think that there is this deviation, how do you determine it, not ex post, but as they come along? Because once George Soros came to the University of Chicago, and he was asked whether he was riding the tech bubble, and he said, I've rode 5 of the last 3 bubbles. Because it's not easy to determine whether sort of a particular phenomenon of price movements is somehow a sustained deviation from fundamentals or not. So I would like to ask now, I go in a row again. So Lars, how would you try to do that? I'm not saying it's easy, but how would you try to do it? Suppose that you are at the head of the Fed and you are concerned about this. What instruments would you use?
Okay, let me take a step back here. I agree that bubbles are kind of this metaphor for something. The truth is, many economists have written down models of bubbles. And I'm sympathetic to this modeling. I'm sympathetic to the formal analysis of bubbles in financial markets. I think we have to take it beyond residual naming in order to get very far. Like discussions in the press and elsewhere are dominated by these stories of ex post bubble spotting. I'm kind of reminded of of a quote that actually shows up in the social science research building at the University of Chicago from Lord Kelvin, who was not a social scientist, whose dictum is that if you cannot measure something, your knowledge of it or understanding is very weak. And measurement is supported by formal models, and that's the only way that I really know how to go about it. Models are important for other reasons too. It's kind of left out of this discussion so far is the fact of that these theoretical models people look at, bubbles are sometimes good. What they do is they support additional financial market transactions. For instance, suppose we have assets that we find have collateral value. Are we going to call those good or bad? So indeed, I don't really see how to get going on this whole discussion of bubbles until we're going to address it in terms of formal models and which models we like and don't like. To my view is there's no models yet that support reliable measurement ex ante. And without such measurement, discussions of bubbles are of very limited value in the design and conduct of actual policy. It's potentially dangerous in the design of our policy to overstate our knowledge and understanding. So until we really produce the models that allow us to do the ex-ante measurement, I think the discussions of bubbles can only be a very, very loose guide and one that should be addressed very, very cautiously. Currently, I view bubbles as being too often linked to impressionistic approaches to time series, and we really need to take this a much further step if we're going to connect it to formal policy analysis.
Thank you. Bob, what do you think?
Well, I got into many conflicts with Gene over during the Nobel week. It was a whole week, and I kept arguing. Every day I was debating Gene Fama. And so Gene was saying, if you believe in bubbles, can you ever predict them, when they're going to end? And I developed over the week a characteristic response to that, which annoyed Gene. I couldn't stop saying it. I said, why do you ask me this? Because you have founded DFA, which buys value stocks and avoids overpriced stocks. And so you are one of the most successful people on the planet in predicting bubbles. He just doesn't want to call it that. So he is expecting me to predict a sudden major drop in markets, which is rare. So,
But you are famous for, among many other things. But
by the way, this is DFA right next to me.
No, I understand. But Bob, in the popular press, you are famous for your book, Irrational Exuberance, that in a sense call the tech bubble a bubble. And the 2005 edition of your book had a very nice graph about house prices that many interpreted as you call also the housing bubble. Right. So it seems that you at least you have, I don't know whether you call other bubbles, but that's a pretty good record with respect to most people, even by George Soros standards. So what are your criteria to call
now let me
bubble?
Get into, well, I agree very much with what Lars just said about economics requiring models and science. But I'm also reminded of another thread in social science, which comes from a completely different direction, from social psychology. And there's a wonderful book by Irving Janis called Groupthink. Mm-hmm. What he refers to is that expert committees of scientists, for example, can have trouble seeing obvious points that don't fit into one of their standardized ways of evaluating things. So the idea is, what was going on during that real estate bubble? Now, I was once on my way to a conference in Miami, Florida, of economists, and the taxi driver, this is around 2005, said, look at all those building cranes out here in Miami. He said, something bad is going to happen. And so then I go to the conference, and the economists didn't mention it at all. It wasn't even discussed that we might be in a housing bubble in Miami. So why is that? This is where we bring in Irving Janis. People in professional organizations can miss big things because they have such a professional sense of competence that they won't even bring up doubts unless they can prove the answer or prove that they're real. And so there is a mystery about this financial crisis, that we had this huge run-up in home prices and in the stock market, and it ended up a crash that almost no one forecasted. So it's a matter of how do you make judgments. When you have to rely on the information of others, but you know that the information channels are clouded by certain psychological or social psychological barriers. And in history, there have been many examples of huge errors made by experts. So I don't know, my conclusion is that we have to pursue modeling, but we also have to keep kind of a broad common sense thing. So I was actually, in predicting the financial crisis, I was relying on my observations of, well, probably looking at data and seeing how prices were going up rapidly, but also just listening to people and the way they were talking. People will tell you things, like businessmen would tell you in 2005, they did tell me the same story, that, well, I'm doing this because it's the thing to do these days. Maybe it'll end badly, I'm not going to think about that. When you have businessmen tell you that, you have a sense of, I wasn't the only one, but maybe I had more of a sense of obligation to talk about these things. But again, it all does have to eventually come back to improving the science.
Ken,
I've forgotten the question.
how do you spot a bubble?
Let me start by emphasizing, I'm going to try to give what I perceive as Gene's answer. Those of you who know Gene know he is pretty outspoken, so many of these issues, it's easy to summarize what we might all agree Gene would likely say. Gene's answer to how do you spot a bubble, I suspect, would be if you can reliably identify a negative expected return on an asset class that should have a positive expected return, and the should there requires a model without a doubt. If you can reliably identify a negative expected return in that circumstance, he's willing to acknowledge that would be a bubble.
He said that, you got it.
So, let me also respond in a way that apparently Gene does not like. Gene's got the thickest skin in the world, and he just doesn't like to get into arguments. He just doesn't find them productive. But let me clarify a bit what Gene might have been thinking when Bob made his statement about what DFA's investment strategy looks like. Let's focus simply on the value effect and whether that is transparently mispricing. And so if an investor chooses to invest in high booked market stocks or high earnings price stocks, whether they are obviously buying undervalued stocks. Let me remind you, it's very easy to say, okay, you give me future expected cash flows, discount those cash flows back at a high rate, I get a low price relative to those future expected cash flows. And I can take all the steps back to current book value, current earnings, forecasts of future expected cash flows. But what I critically want you to hear there is all I had to tell you is there's a high expected return. I didn't have to tell you why there was a high expected return. We can have an interesting debate about why there are differences in expected return. But all Gene thinks he's doing in this context is not identifying undervalued stocks and separating them from overvalued stocks, but simply identifying companies with high expected returns and low expected returns. And we can argue whether that's the result of mispricing or risk. And now I'm speaking for myself. The answer to that question is yes.
Excellent question, excellent answers. I would like to ask one last question, then open the floor, so start preparing for your questions. My last question is a pretty obvious one, even if sort of the prize has been given to all of you for your fundamental contribution to the empirics of asset pricing. I think that we generated a debate on the concept of market efficiency. So I don't want to re-debate the issue. I want to more try to get from you in what way market efficiency, the way you understand, is relevant or helps in sort of the practical world at large. So how should a finance practitioner think about market efficiency these days, and what are the advices you would like to give them? Lars.
Yeah. So I think I'm going to answer a different question that's perhaps related to this one.
Okay.
So let me just start. There's maybe about, I don't know, 6 weeks ago or so, I read an op-ed in the New York Times suggesting that perhaps Singleton's my initial research should be viewed as rejecting efficient markets. It was kind of an eye-popper for me. I didn't quite see it that way. In fact, I saw this differently. We viewed this as we viewed our empirical work as a catalyst subsequently for a variety of interesting explorations of the role of investor preferences, market structures, incomplete market natures, all as ways to confront empirical challenges. And so anything about market efficiency ends up being some type of composite hypothesis with multiple interpretations. But I think these explorations that came out of asset pricing led to a lot of interesting economics and important developments. And they, they maintain, I suppose, some notion of market efficiency along the way. So I think and we think this concept of market efficiency basically had its theoretical origins in the work of Samuelson, perhaps motivated by the earlier work of Bachelet. Eugene's fundamental contribution was to turn this into an empirically testable hypothesis, or hypotheses, and I think that's really absolutely critical. To me, it takes a model to beat a model. And thus, we make little progress by simply rejecting the efficient markets model. And any discussion of rejecting it should really be coupled with a formal alternative model. Now, let me really say that I find the whole term market efficiency to be rather peculiar, coming from a more economic standpoint. As an economist, what we care about is allocative efficiency, and which may indeed be supported by markets. When we discuss financial market imperfections, presumably what we really care about are what are the consequences for resource allocation. And are these consequences substantial or trivial? So I prefer the notion of efficiency is to somehow be connected directly back to allocations. And it seems critical if we're in our assessing role of financial markets to broaden the discussion to really the allocative consequences and not to have more narrowly defined discussions about the market efficiency.
I totally agree, but from a point of view of resource allocation, do you think that the markets overall do a good job today, or the bad job?
So I can only answer that question in the context of specific models. Again, as you can tell, I'm a committed model person, and I think we have to, and I think it's critical for asking this. I think it's a really open question. That when you talk about behavioral anomalies and are these behavioral anomalies occurring primarily in places where the resource allocation consequences are small or big or the like? And I think if we're really going to think about behavioral economics, I think that's the right type of questions to be asking. I don't know the answers, but I hope we can reframe the questions to get better ones going forward.
Okay, thank you very much. Bob.
Well, as I said in my Nobel lecture, I think that the efficient markets hypothesis is a half-truth. It's not completely true. Even Fama agreed with me on one of that. I think he agreed with me, just a little bit off maybe. I think it's maybe half off, but it's still an important contribution. One of the big moments in our Nobel speeches when Eugene Fama showed a plot of an event study, and it looks quite striking. All of the movements happen to the price before the event, and after that, almost nothing happens. I think that was an epiphany. And in the scientific background paper that the Nobel Foundation wrote about the three of us, they cite Gene as the, actually, they were very careful to talk about priority. The first event study in history, apparently, according to them, and as far as I could find out, was by James Dooley, published in the Harvard Business Review, 1933. And it was an article about splits, or split-ups, as he called it. But I went back and read Dooley, and it was all bogged down in details of splits. And he didn't ever say market efficiency. He didn't actually plot his event study. And the big paper was actually Fama, Jensen, Fisher, and Roll. Yeah. By the way, this Nobel, it was awarded to the three of us, but so many other people, like Ken right here, are fundamental and were actually mentioned prominently in the report. So I think of efficient markets as having a real basis, but it's not the whole story. In fact, for the aggregate stock market, it's maybe less than half of the story. But still, I think that it's enough true that the financial capitalism that we live in is one of the great vehicles for human progress. And I wrote a book last year called Finance and the Good Society. The Nobel Foundation didn't mention it. Which I don't know why they didn't, because it puts me very much. I believe that financial markets are a cornerstone of our civilization. And people are a little crazy. History shows that. We're not completely rational. They elected Adolf Hitler, right? That wasn't rational. And these things happen again and again in history. In my book, I refer to investment bubbles that occurred without financial markets. So I talk about the Great Leap Forward in China. Well, that was a bubble, and as a result, tens of millions of people starved to death. Why did it get so bad? It's because they didn't have analysts, they didn't have markets, they didn't. So we live in an imperfect world, but I think efficient markets is an important half-truth, and it motivates the idea of using financial markets to allocate scarce resources. It works pretty well, and I don't know a better alternative. And in fact, in my book, I'm always advocating expanding markets. Well, we started a futures market for single-family homes. Somehow get those working better. We need markets for aggregates like GDP and occupational incomes. So I'm a big promoter of financial innovation, which you might not have thought when you put me as opposed to Gene Fama.
So you're not Myrdal.
I'm what?
You're not Myrdal.
Yeah, that was Gunnar Myrdal, who won the prize jointly with Hayek, was an advocate of the welfare state. Well, maybe I share something with Myrdal. I feel sorry for our poor people. We have to do something for them.
Ken.
Yeah, again, I think I'm safe here in saying I'm representing Gene's views. I won't comment on whether there may or may not be mistakes in prices. I'll let Gene enunciate that one for himself. But Gene, I'm quite confident, would say market prices are a hell of a lot better than the alternative in terms of resource allocation. So at this point, we certainly don't know how to figure out, gee, we could fix that price by some administrative action here. That one's just open and shut when I think about, can I summarize Gene's views? So.
Thank you. So I want to share this privilege I have, thanks to all of you, because I'm simply representing the American Finance Association here. I want to share the privilege of asking questions. So there are 3 microphones around the room. Why don't you sort of stand up and queue on one of those microphones and ask a question to the 3 of them, or even individually to one of them. Okay, go ahead, please. Thanks for breaking the ice.
Actually, I have a question that was touched upon during yesterday's lecture by Chairman Ben Bernanke. What do you think the next economics Nobel Prize awarded to finance will be for? What do you see as those groundbreaking themes that we're dealing with now and in the future? Thank you.
I can talk about what I think are important topics in the future. I cannot comment on what the next Nobel Prize will be awarded for. I think in part what we've learned out of this financial crisis is these linkages between financial markets and the macroeconomy are really important, and there's big gaps in our knowledge of them. And if you look at what happened kind of pre-crisis intellectually, that basically macroeconomics viewed financial markets as some type of sideshow, and lots of work in finance kind of viewed macroeconomics connections as somewhat of a distraction, because macroeconomic data is so crummy. Why would you want to mess it up with better measured financial data? But the truth is, I think the really critical questions are about these linkages, and I do think that kind of building better models and models that are grounded in empirical support is something that's going to be that there's truly some important contributions to be made going forward.
speaking for this, there was a panel in today's program on what macroeconomists should learn from finance. So we are trying to sort of create this environment. Bob, why don't you answer?
Well, I don't have this is just a wild stab. The Nobel Foundation seems to like to put opposing people. So my next Nobel Prize in Finance will be for Bengt Holmström and Dick Thaler.
Ken?
I've not talked to Gene about this one, so I'll buy it, just pass.
But you can still give your opinion. You don't
No,
want?
no,
Okay.
it's not appropriate.
So now that the ice has been broken, go ahead. This is your chance to ask a question.
This is social psychology at work, because if we were around the single table, we'd have...
No, is that your presence intimidates everybody? Okay, there is a question.
Hi. I was just wondering what your thoughts were on the sort of relationship between finance and economics, because as a PhD student, it doesn't seem like they're completely separate, but also not completely connected in the ways that they should be. And specifically on the micro end, what your thoughts are on sort of estimation techniques and the such that might be further used in finance that are not currently utilized to their maximum extent.
Why don't we go in reverse order this time, so that...
It really doesn't make sense for me to dive in on this. We'll let the laureates speak.
Okay, well, this is really impromptu. I think my first thought is finance is a subfield of economics, and a lot of good work goes on in econ departments. Next thought is that traditionally finance has been excluded from universities. Until Joseph Wharton founded the Wharton School, no university had a finance expert, and I don't quite understand why. There's some sense that it's not, there was a sense that it's not gentlemanly enough. And I don't understand now because it looks like such an elegant mathematical discipline that it fits in perfectly in a university. And another thing is that we've long had a switch between liberal arts colleges and business schools. The division before Wharton School was profound. Business schools were really low, really low. They were vocational schools, along with the mechanics schools. And then they've come up, and now they've become more part of the university, but they still have a separate culture. And now an interesting split is between economists at business schools and economists at liberal arts school. And that cultural split is hard to understand because it's the same subject matter. But it seems like business schools have more of a real world contemporary focus. Maybe you can tell me what, you're in a business school, right?
I am in a business school.
But there's a different philosophy about but anyway, I like finance. I'll claim it as part of economics. I'm in an econ department because I very much like to me it's very appealing because it represents a study of the core allocation mechanisms of our society. And I find it a fascinating study for economists.
I will certainly agree about that economics and finance are most fruitfully viewed as finance being part of economics and being actually critical in one of the successful fields of economics, kind of as Gene described in his toast in Stockholm. Part of the question had to do with specific connections related to microeconomics and econometrics. And I do think going forward, an area that has started and I think could produce further work as well is there's been a lot of work done in industrial organization that really embraces a lot of econometrics. And I think working through connections between further connections between corporate finance and industrial organization that really uses econometric methods in formal ways to both analyze models and process data can be very, very fruitful. And so I view that as a potential growth area that can be insightful.
Patrick.
Yeah, I want to come back to Luigi's question about how practitioners will look at the debate around your contributions. So if I'm an asset manager, I'm a pension fund manager, how should I look at your work and your disagreements? Should I just be a passive index investor? Should I try and identify periods or asset classes that seem to me to be mispriced and respond and actively manage the portfolio? So what can a practitioner like a pension fund manager learn from this debate and from the research?
Yeah, go ahead.
This one, I think I can represent Gene's opinion on. He would change the question and say, if you were an investor, how should you behave? Because your incentives as a manager are different than your incentives as an investor. So as an investor, for Gene, it's easy. Almost everybody, if not everybody, ought to be acting as though prices are right. So it just, there's an adding up constraint here that's easy. It's just arithmetic. The average investor invests actively has to expect to lose. To be more precise, the average dollar invested actively has to expect to lose. It has to lose, to be honest. And most, if not every investor out there as individuals would be better off investing passively in Gene's mind.
Could I? Yeah. I wrote a New York Times column about our differences, and I included in my original column an endorsement of DFA. I said, I agree so much with Gene, I think maybe you want to invest in DFA. My editor, so then I thought I shouldn't be saying things like that, so I took it out. My editor said, put that back in, that was great. So it's there. So it gets back to down that we do have a body of knowledge about forecasting returns, and Gene is very important in developing that. And I think that it's useful. So we don't really disagree about. Now, there might be other things that one can learn. As I mentioned, I've been running behavioral finance workshops for decades, and some of our alumni are doing very well managing money. Like John Campbell, my former student, is now managing $25 billion at Arrow Street Capital, and there are others. So I kind of think that thinking about psychology helps you to discover forecasting relations. But again, you have to do the statistical work to discover them.
Lars.
Yeah, I probably have the least to say about this since my research has been, I've not participated much in private sector activities, and my research certainly hasn't been targeted in those directions. But let me say, I think that there remains a challenge which is important both for the private sector and for academic research, and that is quantifying the nature of uncertainty that people confront. And this is more than just putting standard errors on stuff as well. I mean, there's fundamental uncertainty about models and the like, and we kind of use models as approximations, but not as kind of perfect entities and the like. And I think this is a common thing that both affects and should affect academic research as well as private sector research. That is, how do we think about uncertainty in a much more general terms and in ways that are much more meaningful?
Thank you. Please go ahead.
Thank you. I'd like to ask a question that bridges politics and finance a little bit. So I think it's fair to say most of us, all of us in this room, would like to see markets succeed. We believe in free markets, otherwise presumably we'd be Marxists or something like that. My concern that I have is that for the second time in our generation, going back 30 years ago, we've had to go to the public trough for $1 trillion. And so the question that I have for the panel is, should I be more defensive about free markets?
Lars, why don't you start?
There's a non-trivial impact issue about kind of when about the interaction between governments and financial markets. And I think perhaps it shows up most dramatically in things like too big to fail. This can in many ways, once we're in the too big to fail mode, we're almost like working against market discipline in many respects, and so I do think that there's a non-trivial issue about the interplay between government policy and the functioning of financial markets, and there's some, how we deal with issues like too big to fail, how we deal with financial oversight in some type of ways that are useful and socially productive remains an important question. So I really don't think about this as just being defensive about financial markets. I more think about how do we want to fruitfully think about the interplay between government policy and financial markets.
Well, I think there's I don't know how to answer. It was a very broad question you gave, it seemed. But I think we don't have, political science is not as well developed as finance theory. Unfortunately, it's highly relevant, and that's one of our problems going forward. But just looking at the experience, it seems like the government has played an important role in reducing too big to fail, or at least setting the stage to reduce it. So the Dodd-Frank Act of 2010 tried a number of things. It created the Financial Stability Oversight Council, but maybe the most important, and the Office of the Bureau of Consumer Financial Protection. These seem to me like practical, common sense steps forward. I don't know that they solve the problem. Maybe the most important thing that Dodd-Frank did is it created the Office of Financial Research, which now has funding to try to understand systemic interdependencies. We didn't even do research on it because it wasn't, the Fed wasn't interested in it enough because they were a central banker, not concerned with the whole financial system. And academics didn't get enough funding for it. So this is another thing that Gene didn't seem to be warm to the idea of, I kept saying we need the government to sponsor research, and I thought any academic would agree with that. And I didn't quite understand Gene's view about it. He seemed to be resistant to the idea, or maybe I misunderstood him.
Ken, do you have any insight from Gene?
I think you wouldn't like the statement, "We need the government." No, let me be serious here. I think Gene would agree with everything Lars said and maybe expand further on it. So I think he certainly in that general agreement there.
Could I just have a bit of a follow-up? So one concern I have about the Office of Financial Research, which I agreed is an intriguing thing, is I think that in-house government research entities are not necessarily the best way to go. And I think that most useful thing that that entity can perform is making data much more broadly available so that external researchers can actually have access to it. Because I think if you have internal research supporting the Systemic Research Council that isn't itself open to substantial outside criticism, that this is not necessarily a useful way to go. So I just hope the Office of Financial Research, as it goes forward, views one of its main missions as getting data. There's all sorts of confidentiality issues, but these have been addressed in the Commerce Department in other settings as well. But getting data more broadly available so external researchers can also be playing big roles in this.
Please.
You guys are all experts on asset pricing. I was just curious what your suggestions and thoughts on the state of corporate finance research would be.
That's too broad a question.
I think the distinction between corporate finance and asset pricing is kind of run its course, and I think going forward, blurring the distinction is the only way to go. So I just don't like the separation at all anymore.
Bob, do you have something to add? Or?
Yeah, I don't see the split. It was too broad a question for me. I can't.
Do you have some insight from Gene? Okay. I know they say that you can teach corporate finance in 15 minutes, right?
That was in 1960.
I see. Jay.
Going back 30 years, kind of the mantra in textbooks was the equity risk premium is kind of a number typically from Ibbotson Sinkerfield using historical numbers. Ken, you've written with Gene on the equity risk premium. When did you and Gene start to question what used to be taught as the truth as a capital T?
I don't know, we did a bunch of empirical work on it, and, you know, I'm not, it's hard for me to decide when we started to question it, but the result of our papers on the subject, it's somewhere on, our guess was somewhere on the order of 3 to 3.5% a year was the equity premium, a lot lower than the average historical premium.
Any comment? No. Please.
Thank you very much for the opportunity. I just wanted to ask a question that is very likely to be relevant to your area of study, both to the proponents of market efficiency versus the otherwise. So if we believe in market efficiency, and you know, there was just a question about where should we invest? Should we be passive index fund investors versus active investors? So if the market efficiency proposes or prescribes that, you know, the passive investment is the way to go, how do you reconcile the existence, not only existence, but the growth of this actively managed mutual funds versus, you know, why do they exist, and why haven't people figured out that mutual funds really don't do much? So I wanted to hear both from, you know, rational perspective versus behavioral perspective on this matter. Thank you very much.
You want to start, Bob?
Well, maybe someone could explain you've gotten one of the big paradoxes that mutual funds don't outperform the market, and yet people keep coming to them. So I can only think of behavioral explanations for that, and not rational. I guess there are attempts at that, but it seems that there's a marketing works, right? And people who get into the fund management business often discover that their time is better spent marketing than doing research. And let me just say one thing that I advocated in my book, Finance and the Good Society. I believe that we need more fee-only financial advisors. And in fact, I thought this is another role for the government. The government subsidizes financial advisors for the wealthy through the tax deduction you can take. But low-income people generally don't even itemize, and so they have no subsidy. This is just backwards. We need financial advice for low-income people. And then I think that if we did this, it would help this problem, that they wouldn't be victimized by marketing campaigns. They would be getting it. The thing about a fee-only advisor is someone who signs an oath of loyalty to you, the client, and says, I will never steer you toward anything for a commission. Now, commission salespeople have a role in our society, too, as purveyors of information. But I think what we really are lacking right now is financial advice. Someone telling you, someone that you trust because this person has developed a reputation for trust, and maybe more of a community, of intellectual community of fee-only advisors. We have them, but they're not as big and prominent because people can't afford them. So NAFTA is NAPFA, National, I can't get it right, but it's an association of financial advisors who sign a statement of loyalty to their client. And the problem is they charge between $75 an hour and $300 an hour for their advice. It's too much for most people to afford. So I think that it would be just as we subsidize medical care, you don't go to the internet to diagnose, I hope you don't, to diagnose your illness. You go to a doctor. People need a financial advisor. And if we could make that change, I think that's the biggest thing we can do to rectify this problem.
Let me offer an alternative, which would be to eliminate the subsidy for rich people rather than subsidize poor people.
Okay.
I mean, the idea, which, I mean, I'm now speaking for myself rather than Gene, but I too am fully behind fee-only financial advisors, but I don't see why there's a role for the government in this one. But to answer, what was the original question? I've totally forgotten that one again, too. Do you remember what it was?
No,
I can't.
it's too complicated.
Oh, active mutual. Why do people invest actively? I think there's two reasons. Fortunately for all of us who make our living charging tuition, people aren't born knowing everything. So there's lots of ignorance. And then there certainly is a huge amount of behavioral problems, including gross overconfidence. And, you know, the ignorance has to do with the fact that, first, it's a negative sum game out there. Second, the volatility makes the signal extraction problem phenomenally difficult. And then on top of that, people are just grossly overconfident about their ability to identify patterns in random series. So they believe in the standard institution out there needs a 3-year track record to assess a manager's ability. If you actually look and see what can I infer from any 3-year track record, unless it's Bernie Madoff's, you're not going to learn anything.
Last. So, very last. Okay. Okay. So,
If it takes a model to beat a model, what advice would you have for researchers who want to create better asset pricing models and test those models?
I guess I need to stab at this. First of all, be very thoughtful and creative and clever in your model development, and then do a very careful job of assessing it and characterizing what its advantages and disadvantages are over the existing model. I can't give you a recipe for this, for how to be a great and clever researcher and creative one, but it's a tremendously important thing for our profession.
Bob,
I don't know what to add. I agree with that. I think that one thing is that we might focus more on collecting data, or I mean, from my own experience, we created a home price index, and the data was there, but not being used. So we went out and found computer tapes with home price data on it. And I think that maybe we emphasize. People don't think that data work gets them ahead as much, in academia, but maybe you have sort of a moral obligation. Now, for example, on your website, you have the Fama French data up. That was another data collection that's been effort that's been extremely important. So I'm thinking that it's partly a group effort. Coming up with good models isn't one person's job, and we need the people who are doing the less glamorous data work to make it advance rapidly.
last question to Andrew Coali.
Luigi, look at the size of this room. You can see how, and this is not for you, Ken, sorry, it's for Bob and Lars. You have to know that we were all very, very proud to get this recognition through you. And obviously many of us were there in spirit with you in Stockholm. So my question is, what was the best part of that week for you? What was the worst part of that week for you?
We know for Gene the worst part was getting pneumonia.
Can I say, I think my best part corresponds to Lars' worst part, because at the award ceremony, Lars was sitting right next to me, and I was looking over at how ill he was with viral pneumonia. But I felt great. The awards, sorry about this. I was ready to catch Lars if he fell over. But the award ceremony there, it was the music was great, and the nicest thing about it was I didn't have to say anything. So I could just enjoy the whole thing.
The award ceremony was indeed very, very special. I was high on drugs at that point in time, so I actually felt pretty good. My biggest challenge was whether, when I bowed to the king, whether I would make sure I actually got vertical again, and that worked all just fine. But no, it was very, the award ceremony was very special. Having friends and family there to share the experience was also very special.
So I thank you enormously, the two Nobel Prize winner and Ken, for stepping in at the last minute, and
join me in applauding and thanking them.